Hey everybody, welcome to this free edition of our Trade to User Group Weekly Roundup. This is for the trading week ending December 17th, 2021. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is Who Pissed Off Santa Claus? Let's take a look at where we've been, and as we round out 2021, we're going to have a very strong year this year, as we did in 2020. But I think 2022 is going to be a very interesting year, full of surprises. A lot of volatility. There'll be periods of extreme volatility and periods of extreme peace. So let's just set the stage for it. Let's take a look at where we were this past week and then just kind of where we're going as we round out 2021. If you look at the index performance for the week, you can see everybody was in the red. Year to date, still fairly strong. Russell finally came in under double-digit year-to-date returns to 9.86%. Best performing sector for the week was healthcare, worst energy. Valuations, they fell just a little bit. The forward PE ratio came in at 22.06 for the S&P. The dividend yield for the S&P is 1.32. 10-year Treasury is at 1.40. So the Treasury is still about 8.2 bips higher than the dividend yield. The earnings yield for the S&P still at 4.44%, triple four. Still, in the nominal basis, it's negative due to the higher inflation that we got right now. If you subtract inflation from the 4.44%, you're going to be a negative number. The S&P yield over the 10-year Treasury still 0.304. Current VIX was up for the week, a little over 15% to finish out the week at 21.57. So a relatively volatile week for the U.S. markets. Best performing sector, as I said, healthcare, worst energy. Year-to-date sector performance, energy still outperforming everybody else by a solid amount. Energy's up 48% roughly for the year. Staples coming up 13.5%, still in the green for the year. All in all, fairly strong. Now, this past week, it was a very big week, and I had said it was going to be, which is a lot of economic data coming across the news wires. We're seeing a lot of volatility. This past Friday was also triple witching, which is when we get expiration of equity options, futures, index options, everything you may hear. Some people refer to it as triple or quadruple, but either way, everything's expiring and rolling out to the next month or next quarter if you're an indexed option player. So the Feds, as I said, dominated the week. Much of the sentiment around this past week was the Feds, okay? And the Feds came out, expectations, they were a little bit more hawkish than expectation, with a possibility of 3 quarter-point rate hikes for 2022 versus 2. Everybody's expecting a faster taper of $13 billion a month to wind down the asset purchases by March of this coming year. So that was expectation. But, right after the Feds came out, we had a pretty good bump in prices, 100-point move, mostly because Boom Boom Powell had a very dovish press conference. But then after everything sank in over the next couple of days, markets gave up all of the gains and ended up slightly lower from where we started going into the FOMC meeting on Wednesday afternoon. We did get the PPI index, producer price index. It jumped up about 9.6% in November. So again, inflation is still a big issue across the U.S. markets. Treasury yields actually decreased on the week. And for members, we've talked about this in detail before, and I'm going to review it again this Sunday evening on why rates can go down, even when the Feds are talking about hiking rates. Okay, so that's something that we need to watch very closely in 2022. Also tends to tighten the yield curve as well. And then, of course, if we come over and we take a look across the pond and we look at our European performance, you can see, again, in Europe, everybody was in the red, but not as severe as the U.S., okay? The stock, the FTSE, CAC 40, DAX, all underwater, but none of them were over 1% underwater for the week. Year to date, still double digits. The CAC 40 is leading the way at 25.3% annualized returns as we go into this pretty much last week of trading, week and a half, and then 2021 comes to a close. The only one that was green weekly in a big market was Japan. Okay, but if we take a look at Europe, you can see here that the ECB is maintaining their bond buying. They have not, according to the ECB president, Christine Queen Bee Lagarde, they're going to keep the rates where they are right now. But Bank of England surprised everybody. They did a 25 basis point rate hike. So we did see a little bit of a bump there over in the UK. Okay, now if we swing down to Japan, we're seeing that they're still extremely aggressive in their stimulus. Okay, their Bank of Japan came out, they maintain their short-term interest rate at a minus 10 basis points. Okay, and this is because they've got a 10-year target for their bonds at roughly 0%. So that's why, their bonds are sitting plus or minus around the zero line. Everybody expected that. And their central bank basically is doing more stimulus, primarily for small and medium-sized firms. Their projected stimulus is to end by 2022, September 2022 of next year. But just keep in mind that the Bank of Japan is still one of the world's most dovish central banks. They've been dovish for a decade now, more so over the past 5 years. Japan's exports, on a bit of good news, rose in November from year over year of 20.5%. But remember, last year everything was shut down, so any move up is going to move it pretty big. Okay, so we're seeing exports move across Japan. We are seeing exports in China moving up too. But looking at the People's Bank of China, they basically are putting more stimulus in that economy as well to try and equalize their government. They're having major problems with real estate. Their economic readings, by the way, is showing that the factory output grew faster than expected in November, but they're getting a lot of hits on retail sales, consumer spending, and the pandemic, as it is in Europe, it's forcing these governments over in the Asian markets and the European markets to arbitrarily, in my humble opinion, shut down when they shouldn't. But that just slows things down from a growth perspective. Okay, so that's a little bit about what I'm seeing right now across most of these markets. Now, if we swing over and look at the U.S. markets and just kind of see how things are playing it out right now, I'm going to put up on the screen here the E-mini S&P 500 futures. And you can see when it comes up, it takes a couple of seconds to broadcast. You can see that colored bar here. Now, I've had this colored bar since we were all the way over here back into the September timeframe when we were going lower. I said my year-end target for the markets was 4,600 to 4,750. In fact, I put this bar on here, and I said we typically overrun the bar, and this came in at 4,600. So that's how I chose the base. Now, how was that bar derived on my chart? Well, I use a program within eSignal that will plot this out. But at the end of the day, you could do it manually using GAN for time and Fibonacci for price. But if you put it out there, this is pretty much where it would be. Now, remember, I put this out there when we were back over here before we had this big move up. And of course, this big move up, we came up and made all-time highs at 47, 43, 25. And that was made just on Thursday of this week. And then we gave it all up. This all-time high was probably a short squeeze. I suspect after the Feds came out with their information, we just moved up really high and then gave it all up. Okay. And now we're sitting down here just slightly above the 50 EMA. So that's a little bit about where we're sitting right now. We're still above, the 50 is still above the 200. You can see these two colored circles right here, again, generated by a combination of Fed, the fibs, and using that in Elliott wave. I projected an Elliott wave 4, short-term yellow, longer-term this, and then longer-term out here, you can see a projection down to 44.72 as we move out a little bit more forward in time. Now, it cheats a little bit because these circles come together as we move forward. So the middle plot is kind of where it's saying right around 44.72. So that would mean we would take out our 50 EMA. Now, as we go through the end of the year, you're going to see a lot of profit taking, some money coming off the table because there's been strong profits made this year, as I said, right? I mean, we've got the S&P up over 23% for the year, Dow over 15, Nasdaq over 17, almost 18%. So you're going to see some profit taking as the year dies down. Now, keep in mind, this is going to be a short holiday trading week coming up. This Friday will be a full day off. It'll be a Christmas holiday. When Christmas falls on a weekend like a Saturday, then generally Friday is off. If it falls on a Sunday, then generally Monday is off. Because I think it's on a Saturday. This Friday will be a holiday day, so that means most big traders will be out the door come Thursday in the afternoon. They're gone. So we're going to see everybody pretty much settle up Monday and Tuesday this week, and then volume is going to fall off the table. All right, so just understand that for this week. Now, if we come over and we look at the Dow, keep in mind we're over the 50 EMA. We just made new all-time highs in the E-mini. And let me just switch over to Nasdaq first. If we look at Nasdaq, we did not make new all-time highs. We're well away from that. Our last all-time high was on November the 22nd. Okay, and we've now fallen below the 50 EMA. And as I tell our members, generally speaking, the higher interest rates go, tech stocks generally don't like that. Okay, just most hedge funds, most mutual funds use a discounted cash flow modeling tool. Each one of them adds their own little secret sauce to it. But they use that to project cash flow, and they use it to project what's the value of a company now based on future earnings. And obviously, the higher the interest rates go, it reduces the cash out in time. So it tends to reduce valuations. Technology companies tend to get hit harder than most because you're buying for higher PE ratios on the theory that even though their earnings may be non-existent right now, their earnings are going to grow really strong. So we're going to front run all this, invest our money now. So that's why tech tends to get hard. There's going to be a couple of techs that I think are going to be stronger and hold up a lot better. That would be the Microsofts and Apples of the world. Generally, if a tech's got strong balance sheet, strong cash, which Microsoft and Apple do, then they're going to hold up fairly well. Google too. I think Amazon will hold up, but it's still going to be punished a little bit. So this is kind of what we're looking at for NASDAQ, below the 50 EMA. So we can see a little bit more damage possibly going into the end of the year. Now, if we look at the Dow, let me just find the Dow here. You're going to see the Dow is, again, like NASDAQ, slightly below the 50 EMA. You can see it did not make a new all-time high, and we're coming down on this as well. And then finally, the Russell, which is really, it's got me a little bit worried here, the way the Russell performed. And even though it was the only index in the green on Friday, that's more of a counter trend move. But if we look at the RUT, check this out, guys. We're below the 50. We're below the 200. That's an ugly chart. And by the way, right now, the Russell futures, we're in official correction territory. All right, a correction's 10% down. And if I just drop this plumb line down and come down to about where we closed on Friday, we're almost 13% underwater year to date, or from the highs, not year to date, but from the highs. The Russell is still up 9.86% from where it opened this year, but from all-time highs, we're down about 13%. So we are in official correction territory. I find this very interesting, and the divergence between the Russell and the E-mini, S&P 500 futures. The S&P just made an all-time high this past Thursday. The Russell is in correction territory. Now, for those of you that have been trading for a longer time, know that all of this is going to counterbalance out. But right now, the markets are sending a signal, and we've got to pay attention to it. When the small cap index, which tends to be a little bit more of a risk-oriented asset class, most of the companies there don't pay the hefty dividends, right? And I say most, you can pick out a few that do, right? But most of them don't. And they all have higher PE ratios. When interest rates start to go higher, they take it in the face, all right? And that's what we're going to see here. And if this starts to roll over, and then let's take a look at our Fang Index. If we look at our Fang Index, it also gapped lower below the 50 EMA. This Fang Index includes Microsoft, Facebook, Apple, Netflix, Google, and Amazon. So remember, these right here account for over 23%, 22, 23% of the total market cap weighting um, of the S&P. Apple alone is over 6% of the weight value of the S&P. So when these give it up, if money does not go into other stocks, you're going to see a faster pullback in the overall index. Okay. So we're seeing some of that in some of these fangs, although Microsoft and Apple are holding up better than most. Okay. So you guys, we really have to pay attention to this. Now, if we look at Bitcoin, it is off big time. If we look at it, you can see we're coming down and testing the 61.8 fib retracement level from the highs that were made, all-time highs that were made back in November, just on November the 10th. You're only looking at what, about 6 weeks ago, when Bitcoin made all-time highs, and boom, here we go. So is Bitcoin going to go lower and totally come undone in 2022, or is it going to rally and come up and make new all-time highs? I mean, you look at some of these people that try and follow Bitcoin, and you got some of them saying it's going to be over 100,000 in the next 90 days, and you have others that say it's going to go to zero. So obviously there's some truth somewhere in between. This is why big institutions don't put a lot of trading into it, because it's too volatile right now. And it's typically, it follows technical patterns very well because there's really nothing else there. I don't think it holds up very well as a risk off kind of asset play. More like, not like gold, but we've got to watch it very closely. Okay. Doesn't mean that we can't trade it and swing trade this thing for some nice profits, but it's just all over the place right now. And of course, if we look at volatility, if we look at the VIX, Friday was an up day. You can see just when we had that pullback on December the 3rd, a couple of weeks ago, the VIX moved all the way up to 35 intraday, and then it came hard down, and now we're in the red zone, which is down fast markets, right? We're in that zone roughly of a VIX zone where markets tend to be can jump up very quickly. The markets are very sensitive to bad news. We're in this zone, as you can see over here, right? So we've got to watch volatility very closely on this. And of course, if we look at treasuries and the bond market, Friday interest rates actually went down. In fact, let me just see if this thing will refresh real quick. If you look at the bond market and we come out here like this, you can see if we come back to, this is a 60-minute chart. So if we come over here and we look right around here, this is when the Feds came out. You see the big move up, the big move down, the big move up. Since the Feds came out, bonds have gone higher, interest rates have gone lower. Okay. So members, I'll review this with you again so that you have a better understanding of what in the heck is going on in the bond market. And it's really, for longer term investors, doesn't paint a very strong picture. And of course, if we look at excuse me, the 10-year interest rates, you can see similar thing here. The rates have come down. Tried to make a rally post FOMC Fed meeting, but it's come right back down again, right? Again, not very good. Okay. If we come over and look at currencies, look at the dollar. Zippity doo dah, straight up, right? Challenging 2021 highs. Remember, it's really not the dollar, it's the dollar index. It moves based on where the euro, yen, pound, Canadian dollar, Swedish krona, and the Swiss franc move. The euro pretty much controls the bulk of it. Euro is about 57, 58% of the value of the dollar index. And Europe, because they're locking down, because they treat the Omicron variant like a plague, which it's not, I think all these vaccines and all this other stuff is prolonging the herd immunity. And it's causing the variation in these virus variants. It's causing more variants out there. So anyway, Europe's doing that, so it's hurting the euro and others, and you're seeing the dollar get a lot stronger. And of course, if we look at the euro, just the opposite happened. We're back down, challenging these lows down here. in the euro. Okay. So I want to see if it can get a little bit more of a consolidation. When Europe starts to straighten out, I think the euro is going to be a nice play to the long side, right? But not right now. We need to get through it over the next week or two, 3 weeks, 4 weeks to see where it plays itself out. And of course, if we look at gold, as I mentioned with gold, had a little bit of a bounce, but I think longer term gold's going to go higher, but it needs to sort itself out right now. And right now, it's still being pushed down, believe it or not. Okay, same thing with silver, copper, same thing with copper. Copper's got a double whammy going on right now. They got two competing forces with copper. One is EV vehicles. EV tends to use um, electric cars, electric powered cars use 40% more battery copper components than gas powered cars. So that's going to put a demand on copper, and you can't just grow a copper mine overnight. But what's hurting it near term is China. When China is slowing or stopping completely a lot of their building real estate projects, well, guess what? No more need for copper, at least in the near term. So I think we're in this long, choppy consolidation zone before China straightens out and copper starts taking off again. Okay. So those are the competing forces there. And then, of course, if we look at oil, if we look at it had a pretty rough down day on Friday as well. I said that oil is going to run up. I would fade this rally to come back down, settle in, and then start a longer slug higher again. Okay, that's where I see oil. You can see my various support points generated by the system. That was the first, second, and then this was the third. And we blew through all of them in kind of a flash. I would call it a flash crash. This one day here, we were down over 10 points in one day. That was back on November the 26th. And then we kind of tried to climb back up, but it's just going to push it back down again. Longer term, members, I'll review with you some great ways to play oil in 2022. All right, everybody, that's kind of where we're sitting right now. We got holidays coming up. So next weekend is Christmas weekend. The weekend after is New Year's weekend. So I'm not sure if I will be getting our weekly roundup out. Members, we've got our session coming up this coming Wednesday morning in our pre-market trader overview for the markets as we round out this year. Everybody have a great holiday season. Spend it with family, friends. Enjoy it. New Year's, everything. And for you folks out there, I will see you in the new year. Members, I'll see you this tomorrow night, actually, for our weekly market watch. Take care, everybody. Ciao now.